Hello, everyone, and welcome to today's webinar. My name is Louisa Gaynor, and I'm a Senior Client Advisor here at Netwealth. And I'm joined today by my colleague Fred Smith, who's another advisor on our advisory team. And together we're going to be talking you through the key points to consider when thinking about holding cash versus investing in 2024. So we're going to kick things off with looking at why we should even think about investing, particularly in the current economic environment. And actually, when you do decide to invest, the importance of setting your goals and preparing for risk, and then managing that risk by ensuring you have a robust investment framework in place. We're also going to try and highlight the importance of being really thoughtful around your financial plans. And we're hopefully going to demonstrate how you can do so using our net wealth tools, both through modeling for your financial future and also ensuring you're utilizing your tax wrappers and allowances each year. Fred's then going to close the session by talking about some of the strategies for getting invested from a position of cash. And he's also going to provide a bit more insight into the net wealth services and how we can hopefully assist you. We've had quite a few questions submitted before this, so thank you very much for those that have done so. We've really done our best to incorporate these in the topics we're going to cover today. But if after the session you have any follow-up questions or you'd like to speak with myself or Fred directly, please do get in touch with us at advice@netwealth.com and we can arrange time to speak. So thank you everyone for your time today, and I'm now going to pass over to Fred to start us off on the session. Thanks, Fred.
Thank you, Louisa. So as Louisa said, we're going to go through a presentation today looking at basically the relationship between cash and investing and the impact of falling interest rates, and go through some broad principles on how we think about investing and hopefully help you come to some decision making, but also let you know that we are available to help if required. So just firstly, why invest? So you will have all be aware of interest rates going up in the last year or two. Before that, interest rates were very, very low. And the relationship between interest rates and investing is quite important because you can get a good return on cash. So historically, interest rates were much higher. So there was a cash as an asset class in itself was probably more attractive. You could still likely get better returns from asset-backed securities such as equities, bonds, property. Um, but holding cash wasn't necessarily the worst thing in the world if you were a very low risk investor. From 2008-9, the global financial crisis, interest rates were cut dramatically, and there was almost no return to be had on cash. So just above zero rates in the UK, but other countries did have negative interest rates, particularly over in the European Union, in the Eurozone. But recently, interest rates have been going up, so you've been able to get an attractive return on cash there, whereas for about 13 years, the only place really to generate a return was equities and other asset-backed securities. So we think interest rates will be cut this year. They're likely to start falling in the next few months. There could be 2 or 3 rate cuts this year, probably towards the end of the year. It will partly be related to the economic data coming in around unemployment, wage growth, inflation, and the general health of the economy. But it may be the case that interest rates start to fall to boost the economy and get some more economic growth. But if they do fall and level out, we would expect them to fall to around 4.5%. So higher than the recent history standards, but still relatively low for broader historical standards. And we think that this still means that investing in other assets is attractive because you will not get the returns you want on cash over the long term. You'll struggle to beat inflation. In most cases, you'll be below inflation. And you'll likely be left behind from other asset classes, which we'll demonstrate here. So it's really important just to hold the correct amount of cash and not use it too much to generate return. Hold enough cash for your reserves and where you feel comfortable, but to generate a real return above inflation over time, you will need to invest. As we can see here on this chart, so if you had £100,000 in 2007, just before the global financial crisis, and if you extrapolated that to today, where would you be? So cash, as interest rates were rising briefly, would have increased the real value of the money, but generally over time the real value of that money falls as the value gets eaten away by inflation. Alternatively, a mixed portfolio, so risk level 4, which is a relatively so it's a moderate risk portfolio. It's balanced between equities and bonds. There's some alternatives in there as well, such as gold and commodities, and some cash. But really, it's sort of broadly 40% equity, broadly 40% bonds. That will have dropped initially as the financial crisis went underway. However, as markets recovered, you would have seen the real value of your portfolio go up, factoring in inflation. So the real purchasing power of that money now would be higher than it was in 2007. and significantly more if you just held cash. I know some of you may be thinking, okay, well, could we have timed the market in this area here? So at the beginning, between 2007 and 2009, if I'd have held cash for a year or two, would I be in the best position? That is partly true, and with hindsight, it's really easy to see that. But in practice, it's very difficult to know exactly what markets are going to do, when interest rates are going to start falling or rising, when there's economic growth to be had, and when markets start getting more confident and booming. So if you had missed at the bottom of the market and bought in at a different price, it's very unlikely that you would have achieved the effect you wanted to do. And it's more likely that you may have got back into the market at the wrong time or left the market at the wrong time. It's just very, very hard to time it. So moving into cash in times of market uncertainty can be a strategy, but we generally don't advocate it because the most important thing is to be in the market, and to have the right asset allocation moving forward. So have the right amount of bonds, the right amount of equities, the right amount of cash for your personal circumstances, needs, and objectives. Time of the market can lead to um, I guess some mistakes potentially, and we'll show that later, and the impact of missing rises in the market. But generally, you are rewarded for taking risk, even though the journey might not always be smooth. And this demonstrates that too. So markets can be volatile, and we do know that from our own experience of investing. Even in years where there's a positive return at the end of the year. So you'll see here the grey bar shows the return in that calendar year. So you had a fall in 1994, but then you had rises in 95, all the way through to 99, then falls in 2000, 2001, etc. Even in those years where there's a market where the market ends in a positive period, there can be quite significant intra-year drawdowns. So even here, where you see 2009 finished the year 30% up, there was a point where it's 30% down, or 25% down or so. In years, another significant ones here in 1998, the FTSE ended up around 13, 14%, but it had fallen more than 20% during that year as well. So even when markets are positive, there is a lot of volatility, and that's a trend that's likely to continue. So it's about not being too concerned with those volatility. That's part of the process. But generally, if markets are falling, that doesn't necessarily mean that's a broader thing to worry about, because markets will be up and down as new data comes in and analysts reprice equities, and there's quite a lot of economic information coming in which has to be analyzed, and that feeds into the market. So the information that comes in can lead to volatility, but generally, even if there is falls, you may see quite quick recoveries. So it's important to understand that, be in for the journey, um, and not take risk where falling markets can be a problem. So that's when we do want to use cash, but not too much cash where we lose out on these higher returns available from other assets. Um, and just to make that point again, we've seen this chart a minute ago where the cash line versus the unbalanced portfolio line. Um, but this blue shaded area just demonstrates the what's happening into the market as well. So the market was falling, and you're seeing therefore that the balanced portfolio is falling slightly for a couple of years. But even so, and you're taking withdrawals from the portfolio, it still makes sense to invest, because even though your portfolio is falling while you're taking income, and the same thing's happening from the cash, eventually the market does pick up and you get some quite strong growth. And then so the amount of units you're selling to provide your income falls, the drawdown rate falls in tandem, and therefore you're able to sustain that drawdown rate for a much longer period in relation to the cash. So if you were to start that £18,000 a year withdrawal in 2007, you would still have £80,000 today, having taken a moderate level of risk. Whereas if you'd had the cash, you would have run out of cash last year. So it still makes sense to invest even if markets are falling, because markets will start rising again. And we kind of factor that into an extent, the volatility, but ultimately you're going to benefit from the relationship between markets rising and your drawdown. So even if you are drawing income, it can still make sense to invest, particularly even if markets are falling, because we're going to see that recovery coming soon. So where to start? So we think of the three pot theory as being a good way to think about investing and how to categorize your assets. Some of you who have been in our presentations before will have seen this already, and we do like to emphasize this when talking to clients, because it really is underpinning a lot of how we think about investing. So it goes into three pots. The first pot is your kind of cash pot, salary, cash, dividends. This is money coming in, and this is going to meet your short-term needs. It generally doesn't make sense to invest this pot because you don't want that to be subject to volatility, because you want to know how much money you've got and you want to see your bills coming out every month. Um, and that wants to be a certain, you want an element of certainty there. It's really going to be relatively small pot. If you're working, maybe 6 to 12 months of your target spending, keep that in cash if that's possible. When you're retired, maybe you want to hold a bit more cash as a reserve, 1 to 2 years. But generally, sort of 6 months or so of your annual spend should be held in cash if possible. So that's your pot one. Your pot three, if we go to the other side of the coin, is your property, your single stocks investments, direct investments, higher risk assets broadly. So your main residence is going to be a long-term asset. It's concentrated in the UK property market, but you buy that for a good reason, because it provides a home for you and your family. Um, so that's going to be potentially more volatile. If you actually look at your house price changing on a daily basis, you'd probably be quite surprised, but we generally don't look at it on a daily basis because it's a fixed asset. But your single stocks investments, maybe you work and you get rewarded stocks when you work there for a long period of time. These can be quite volatile. Equally, there may be some stocks you've inherited, which you want to keep. Maybe it's a company a relative worked for, or you worked for, but you retired and you kept those stocks, or just companies you like and you've done your research on. You want to hold them for whatever reason. But generally, this pot three is going to be more volatile, potentially more risk, um, potentially longer term assets too. And that's something that you can manage yourself. An advisor can take those into account, but generally will kind of avoid taking too many decisions on those. The pot two, this middle pot on the arc, is really where a wealth manager or a financial advisor should come in, and that's where we can assist. It's a liquid, low cost, medium to long term investment portfolio that's very diversified and stable with professional input. So this is where decisions are going to be made by professionals on a discretionary or an advisory basis. Going to be diversified um, by company type, company size, by region, by asset class, and it's going to be managed on your behalf. Your pension is probably one that everyone has, whether it's auto enrollment or a SIP, and that will be being managed on your behalf or with your input. But that's where we can assist, and that's where we think the wealth management industry generally can assist for most people. So setting goals and thinking about risk. Goal setting is really important, and time horizon comes into this too. So why are you investing? It's important to think about this. Is it for a regular withdrawal, so an immediate income, or is it an income in the future? If it's an immediate income, and depending on the level of withdrawal, that's going to impact how much risk you can take. If you're taking a low amount per annum, somewhere between 1 and 4%, it may be the case that investing with a higher degree of equities is prudent. But equally, if you're taking a much higher percentage of your assets every year, you probably want less volatility, so that you're avoiding withdrawing large amounts of markets that are going down. So the need is going to be very important, and the time horizon. If you don't need to start withdrawing money for 5, 10, 20 years, then it's likely that you can take a bit more risk, assuming you have the willingness to do so. But it's also important to factor in the ability and need to take risk too. So it may be that you don't need to take very much risk to achieve your goals, in which case it's more going to be about your willingness to take risk and how comfortable you feel if there's volatility. Or it may be that you have quite stretched goals and you do need to take a bit more risk to really grow your assets, in which case then taking a calculated level of risk, working with an advisor, is likely to be a good strategy. And other needs such as school fees, is it going to be 10 years time? Again, thinking about that time horizon, when you need it, or paying off a mortgage or long-term retirement. So all those are going to impact how you invest and the amount of risk you invest with. Some people just want to invest for a rainy day, an unknown goal, just grow their assets, in which case it's going to be how much risk are you comfortable with, really. And that risk is generally set between the types of equities you purchase, how diversified it is, the type of bonds you purchase, and other assets such as property and commodities and other alternatives. So really think about your goals when you're investing, and have that at the forefront of your mind. Um, and if you look at our portfolios, we have 7 risk portfolios. Risk level 1 is low risk. This is cash and cash-like investments. As you move up the spectrum of risk to risk level 2 up to 7, you start introducing more equities. There's equities which are going to grow the most over the long term in most circumstances. But they're also going to be the most volatile. So when you do invest in equities, it is important to understand that potential loss, particularly in short time periods, can be higher, but then potential returns can be higher as well. Over the long term, the risks reduce, um, and the average return will hopefully increase, unless you entered into the markets at a very positive time when it was at its bottom, and then you got the benefit from a short-term boost as markets rose. But generally, taking more risks is going to increase the risk of loss, but over time, you can reduce that risk, which is why time horizon is very, very important. And this just illustrates that point. So if we compare a risk level 2, which is a very cautious portfolio, very low in equity, mostly bonds and cash, to a risk level 4, which is a balanced portfolio, to a risk level 7, which is high risk, 90% plus equity portfolio, you can see the percentage of times you would have lost money in 25 years. Most people, after investing for 2 to 3 years, will probably start to see positive returns, even in negative market environments. But even if you haven't seen that positive return, it's important to understand that that is a risk of investing. It will take sometimes up to 5 years to have, in almost all circumstances, a benefit from investing. So in 1 month time periods, even the lowest risk portfolios can lose money, but you're more likely to lose money in the higher risk portfolio in a very short time period. In a 6 month time period, there is still the risk that you can lose money. Now, even in the lowest risk portfolio, there's about a 20% chance that may have gone down. And in the risk level 7, the higher risk portfolio, in about a third of cases, the market may have impacted it, so that the value of your investment falls. Over a 1 year period, we start to see that risk reduce even further. But the risk level 7, which is an equity-based portfolio, will still have a high chance of being lower than it was when you first invested. And that's why with the highest risk portfolios, you need to have the longest time horizons to really benefit from the full cycle of markets. So that's no boom, bust, no recovery, etc. It may be the case that when you invest, there's a negative year, and it may take some time to recover that. But over a 10-year cycle, you're likely to see the full benefit of stock markets rising. So in a 5-year period, there's almost zero risk of a medium and low risk portfolio losing money, but there is still the risk that a high risk portfolio could be down, but that falls to almost zero after 10 years. It's important to bear that in mind when selecting your portfolio. And then controlling the controllables. So before I hand over to Louise, I just wanted to just emphasize what we can control and what you can think about when you're investing. So what we can control is time in the market, and hopefully those previous slides demonstrate that investing over a long time period does reward you, and it's very hard to time it correctly. So being in the market rather than timing the market is generally the most important thing. Diversification to smooth returns, and it's something that will be shown in a later slide more visually. But generally, diversification is really important factor, and it's often called the only free lunch in investing. If you can have access or exposure to different asset classes, different regions, different company size, different types of companies, different bonds, long dated, short dated, etc., government bonds, corporate bonds, alternatives such as gold and commodities, possibly also property, and also cash as an asset class. That will help smooth returns because those asset classes will have some inverse correlation, and that will help if one asset class is falling, another one might be rising. And that just keeps you a more stable journey through the process, and that could be very important to avoid those very large falls, which can happen if you're too concentrated. Using all of your available tax allowances and wrappers too. Pensions, obviously tax relief, you'll all be aware of this, and this can be extremely beneficial and help boost returns as you get tax relief, but also tax-free growth. Equally, using your ISA allowances, although there's no tax relief, all of the growth and income is tax-free. So, and then you also have your capital gains tax allowances and other allowances, such as dividend allowances and personal savings allowances. So if you can invest in a very tax efficient way, then you're going to do better than if you haven't invested in a tax efficient way, just because you're reducing leakages in the system. So you can improve your gross return. And minimizing fees. Similar to using your tax allowances, if you can reduce the amount of money that you're paying to invest, so this is what you're paying to your fund manager, what you're paying to an advisor or a wealth manager. If you can reduce those costs while not compromising on performance, then you're going to be in a better position as well. That's so important. But what we can't control, and we can't control market performance in the aggregate. So obviously our asset allocation process can be robust and making sure you're taking the right level of risk to not expose you to too much necessary risk if markets are doing badly. But ultimately, we can't control how the market performs, and that's why diversification becomes very important. We can't control the level of inflation. Um, Again, that can, as we saw in the cash versus the balance portfolio chart, inflation can erode the value of your capital if not invested. So, and that's what happens. We can't control inflation, but we can mitigate the risk of inflation somewhat by using diversification, by using the right tax allowances, by having the correct asset classes in your portfolio. And equally, we can't control our mortality. Um, we don't know how long we will live for, so it may be the case that you will live longer than you think. It's important, therefore, to have that in mind when investing and set goals which look achievable over the long time period. So not to draw down too early or too much if it looks like you're going to run out of assets in your 70s or 80s. It may be the case that you want to consider, if I do live longer into my 90s, do I need to adjust the level of income I need to draw? Or do I need to adjust the level of risk that I'm taking? So working with an advisor, and that's something we can help you at Netwealth in the advice team, um, can help you think about these different things, mitigate these risks, but also then control what we can control with the aim of boosting your returns over the long term. So I'm going to hand back to Louisa now. So thank you for listening to the first part of the section.
Thanks, Fred. Yes, so as we can see on the screen, what I just want to delve into next, and what Fred has already touched on, is the importance of having a robust investment framework in place. And I think this first graphic that I'm going to show you demonstrates it quite nicely. So what we are looking at here is what we call a market quilt. And it's designed to help us think about diversification in a bit more detail, as this, as Fred has already said, really should be your first layer of protection within your portfolios. So it's really about ensuring that you've got a number of different asset classes which have different drivers of return to help smooth out that investment journey. And we call this a market quilt really because of the wide array of colours that you can see. And hopefully the first thing you notice is that there's really very little pattern or order to these colourful blocks. So what we're looking at in the columns is every year from 2007 to the end of 2022. And in each column, we've ranked the different asset class returns for that year. So the higher an asset class appears on the chart, the better it performed in that year. And you can see there's very little to discern in terms of predictabilities. And I think that's the point here. It's really trying to show you that it's very difficult to know what any given asset class is going to do in any given year. We do, however, know, and we can see from this chart here, that there are certain relationships that do hold true between different asset classes. If we take 2013, for example, so in the middle of this quilt, and looking at commodities, which is in the very light grey box to the bottom of the chart, when it's underperforming, emerging market equities, which is in the pink box, tends to do less well than developed market equities, which is in that bluey green box at the top of the quilt. And that's a theme that runs true through time. So that's something that we can bake into our portfolios to provide an extra layer of protection. But I think actually the most important thing about this chart is that you should be able to pick out a white box in each year that says the word portfolio on them. And that portfolio reflects our Netwealth risk level 4 portfolio, so our balanced portfolio. And going back on a simulated basis, we can see that this box never sits at the top of the chart, but also never sits that close to the bottom of the chart. So really importantly, it provides this layer of certainty that you're not going to see extreme movements in your portfolio returns because you've got a lot of different drivers that are impacting the overall performance. And that really is the whole point about diversification and how it adds protection to your portfolios. So how do our investment team here actually manage our portfolios to ensure they remain globally diversified whilst factoring in sub-asset classes to hold within each risk level at different points during a market cycle? From a net wealth perspective, there are three components to our investment approach. The first and the biggest factor in determining the risk return characteristics of our portfolios is the strategic asset allocation. And that's the strategic asset allocation that we apply at each risk level. This really represents our views of what the best mix of asset classes are for any given risk level over a longer period of time. So if you were to invest in a portfolio, not touch it, and come back in 20 years' time, this would be what we would put forward at our best estimate as how you should be positioned over that 20-year period. In reality, however, we try to be much more proactive than that. So we think it's important to keep a view on how the different asset classes shift through a market cycle. And over, if we look on the right-hand side of the page, we can see that overlaying the strategic asset allocation is the adjustments we will make to the cyclical positioning of our portfolios. So we think that the given risk embedded within a strategic asset allocation at any given time can be slightly mitigated or improved by adjusting the cyclical positioning of the portfolios. And we also think we can take opportunities there as well with some of the adjustments we can make. The aim, or the overall aim of that, is not to be over trading or to have knee-jerk reactions to certain abrupt market movements, but really is just over the medium to long term to smooth the path of portfolio returns for clients, and hopefully then giving them more confidence in investments they're taking. So we've also, or Fred has also briefly touched on the importance of cost efficiency and keeping fees low. And this really is at the forefront of our minds when we invest for clients. A key part of our investment approach is this middle pillar here, which is about instrument selection. So we primarily use passive instruments within our portfolios. So that tends to be exchange traded funds or index funds. And this is really opposed to us trying to pick specific stocks or more expensive actively managed funds to populate our portfolios with. And a key rationale for that is because we like to ensure the portfolios remain liquid and low cost to run, while still being able to deliver on the desired diversified exposure that we're targeting. We would rather take those market returns and deliver a greater percentage of them back to our clients. So rather than letting the more expensive funds erode away at the net take home return, we give those back to you, which compounded over time can make a significant difference to your overall wealth. And then this slide here is just really showing a snapshot of the asset mix as a whole across the 7 of our risk level portfolios. So we've got risk level 1 on the left-hand side across to risk level 7 on the right-hand side. And you can see here that in the lower risk levels, these portfolios tend to have a higher exposure to assets such as cash and fixed income. But as you move across to the right-hand side of the chart, and as you approach the higher risk levels, the exposure reduces in favor of equities. The team will also actually be quite thoughtful around which equities and what bonds they want to put within our portfolio. So at risk level 7, for example, you have a much smaller exposure to bonds, only 8%, and over 5% of this is made up of much more risky bonds, with being the emerging market government bonds. Whereas conversely, if you look towards the left-hand side of the chart and risk level 1, this portfolio is predominantly made up of a money market fund. It's about 70%, with the only bond exposure being very high quality, short-dated corporate bonds, so a much less risky portfolio. It's designed actually to be only more slightly risky than holding cash. We also think about currencies separately, which you can see in that second set of bar charts. So as we move up the risk return spectrum, we're transitioning from a predominantly sterling-based portfolio to a much more diversified portfolio mix from a currency perspective. And this is always done in a really thoughtful way by our investment team. So at a strategic level, for example, we've been pretty unsure as to the benefits of holding euros within our portfolio. So from that perspective, the European equity exposure we actually hedge that back to sterling on a currency basis. Whereas we like having exposure to the US dollar and the Japanese yen, and so we leave those positions unhedged within the equity part of our portfolios. And then again here, just to drill down a little bit further to this, what you're seeing is a much more detailed breakdown of the asset allocation and the currency exposure within our risk level 4 portfolio. And what this hopefully makes particularly clear, specifically in the 2 charts on the right-hand side, is in fact that the portfolio are made up of a number of different asset and sub-asset classes. The bar chart at the bottom also shows that the team will consider which positions to hedge and unhedge based on what opportunities and risks they see in the market. So what I'm really trying to show here is that even though we're investing on a passive basis using ETFs and index funds, there is a good level of granularity to provide the intended exposures in a much more efficient way for our clients. The mix of those assets will generally change through times, but the overall aggregate risk that's embedded within this particular portfolio will remain the same. So if a client has chosen a balanced risk level 4 portfolio, the overall risk and return they should expect to receive in that portfolio won't change, but the underlying investments will, just to smooth that path of portfolio returns for clients. And this brings us on quite nicely to just a couple of examples I wanted to show about the different drivers of performance for different asset classes and why it's important to have a combination of these within our portfolios. So what we're looking at here is the performance of UK fixed income during periods of stress in the equity markets. And we're looking at the years 2004 all the way to the end of 2023. And in each bar, the area that is shown as blue shows the biggest intra-year drawdown for the equity markets, and the area that is shown as grey shows the fixed income returns during that equity drawdown period. So what we can see here is that generally speaking, during periods where the equity markets come under stress, the bond market actually tends to strengthen and therefore somewhat mutes the level of loss clients are seeing within their overall portfolio performance. And this is particularly clear if you're looking at the center of the chart around the years 2007 to 2020. If we look at the right of the chart there, and I'm sure this is fresh in everyone's minds, more recently at 2021 and 2022, we've seen pretty unprecedented moves in the bond and equity markets and their relationship with one another. In 2022, we can see that specifically when we saw both asset classes perform poorly across the board, which had a significant impact, particularly on our lower risk portfolio, but across the world of investments for most clients everywhere. Any significant periods of volatility or weak performance from a multi-asset class portfolio is, of course, uncomfortable to experience. However, we don't believe that it negates the role of bonds within our portfolios during a complete market cycle. And we can see that stands true when we look at last year, so 2023, on the chart here, right at the right-hand side. We can see that the negative correlation and the relationship between bonds and equities has started to right itself. Bond markets have reset. Central bankers have resolved to tighten against inflation by raising interest rates, and the yields in bond portfolios provide more of a cushion to manage future uncertainty. And we've seen this in our portfolios and their performance over the last year, or over the course of 2023 at least. So, as we've already mentioned, when we're reviewing portfolios, we will do this on a regular basis and we will be making small cyclical adjustments to the bond allocation in order to try and mitigate the risk and also to take opportunity where we see them. But it is very unlikely that we will ever remove bonds completely from our portfolios because we do believe there is still a role for them. And I think this chart demonstrates that quite nicely. And I think one other point that I just wanted to touch on briefly was looking at the importance of diversification across different regions as well. So what we're looking at here is the movement of the US equity market and the emerging equity markets from 2004 to the end of 2023. And we can see that since the global financial crisis, the performance of the US markets or the US equity markets has really dominated all asset returns and has outperformed emerging markets quite significantly. And that's why it's really important that we retain our exposure to the US, as I'm sure many of our clients have within our portfolios with other wealth managers as well. But what we can see here, however, is that the path of return for both portfolios or both regions is really quite different. Looking at the emerging market line, what we can see is that it's a much more volatile experience. You get periods of much stronger growth, followed by quite sharp drops and quick recoveries. So it shows quite nicely the rationale for having exposures to both regions within our portfolios and within our equity positionings. We don't want to commit to one versus the other because they both add value at different points during a market cycle and over an investment period. And then the final point I wanted to just raise here before I change things up a little bit about our investment approach. And this point I really wanted to address because I've been asked a couple of questions around active versus passive investing and whether it is still worth retaining passive funds within our portfolios. So passive funds as a whole are becoming much, much more popular. People are attracted to their low fees, their liquidity, and they're also becoming increasingly aware of the longer term underperformance of active managers. But there are some out there, of course, who still claim that active managers will ultimately prevail, that they should be able to outperform the markets during a downturn and deliver sustained outperformance over the long run. So in theory, this means that active managers should have actually done really well over the last few years. We've had seriously disrupted markets. We've had the pandemic, we've had rising inflation, interest rates, as well as the war in Ukraine, now the Middle East, and with the elections coming up this year as well. So this should theoretically have created an environment where active managers do quite well. The uncertainty should have provided them with the opportunity for their skill to be rewarded. However, what we can see from this table here is that exchange traded funds have consistently beaten their peer group of active funds, whose sole purpose is to outperform them. On this table, we're looking at the performance of ETF versus the active peer group as of May 2022. And what we can see is that ETFs have beaten the market on a year-to-date, 1 year and 3 year basis in each market environment. So across the UK, the US, Europe, Japan, and global emerging markets. There has only been one exception to this over the longer 5 year period, and even then the results are pretty close. And the reason for this is that often active managers just aren't nimble enough to capture the opportunities from the turmoil, and so aren't able to outperform when they may be expected to do so. And so this is why ultimately we just believe that investing primarily on a passive basis makes sense. Using these ETFs as the building blocks for our portfolios means that we can deliver a better net return and at a lower cost to our clients. And it gives a nice tailwind to our performance, which you can easily see on our website, or if you email us at advice@netwealth.com, we can send our reports over to you as well. But now I just want to change things up slightly as I'm going to look at our online modeling tools. And these tools you're able to access by simply registering with us at netwealth.com. And someone from our team is hopefully going to pop into the chat box a link where you can register on our homepage, and so you can access these tools. So what we're going to look at here are the modeling tools. So really, these are where you can plan for your financial future and have a look at the impact of changing the variables within your financial plan. So I'm going to take a bit of a case study here where we're saying we've got an individual who's looking at a retirement goal. This individual knows that when he retires, he's fortunate enough to have qualified for his full state pension. So that in today's value is going to give him 10K a year of guaranteed income from the age of 67. And he was also lucky enough to have a DB pension, which also provided him with an additional 10K of income when he reaches his normal retirement age. His overall target annual income that he wants to achieve in his retirement is 80K per annum. So he's got that 20K of guaranteed income. So that's a shortfall of 60K per annum that he then wants to draw from his retirement assets. So that equates to £5,000 per month. Now, Fred has already highlighted that inflation is one of the uncontrollable elements of investing, but whilst we can't control for it, we can model for it, and it's really important that we include that within our financial plans. So although inflation is quite high at the moment, we would imagine that over the course of our retirement and over the longer term, it's going to settle somewhere between 2.4 and 2.7% per annum. So to be cautious, I'm going to factor in a rate of 2.7% per annum here. This client that we're talking about is 55 years old, and he would like to retire at the age of 65. Oh, not 95, that's far too old. And again, how long would he like his retirement to last? This is another issue that Fred raised earlier about mortality and the length of retirement. So we tend to encourage clients to model to the age of 95. So I'm going to put a 30-year time period here. Now, but it may be that this client has accumulated throughout his period of working wealth through his pensions, through regular ISA contributions, and it may be that he saves across his and his family accounts as well. But for the purpose of simplicity, I'm just going to assume all funds are within a pension. And here I'm going to say that his combined pension and ISA pots are £950,000. And that within that, each year he's topping up his full ISA allowance, so £20,000 per year. So that equates to £1,667 per month. And he's also maxing out his pension contributions each year. So he's a additional rate earner, and unfortunately his pension contributions or his annual allowance is tapered down to the minimum of £10,000. So that equates to monthly contributions of £833, which we're going to assume that his employer makes on his behalf. So in total, that means contributions to pensions and ISAs each month of £2,500 whilst he's still working. And these are his gross contributions. And this is just really trying to emphasize that it's so important to think about being efficient from a tax perspective in the accumulation phase of your life as well as the decumulation phase. And then this is where we get to the different risk level portfolios that we offer. So we've got a range of 1 to 7 that we've already been through in a little bit of detail. And risk level 1 has been redesigned quite recently to capture the high interest rate environment that we're currently in. It's known as our liquid reserve portfolio. It's only slightly more high risk than holding cash, and it's a great place for clients to use their funds as a holding pen, a credit risk diversifier. It's got a current underlying yield of about 5.3%, and clients may hold their cash here before they look at drip feeding it into a higher risk level portfolio, or if they've got it earmarked for a capital expense coming up in the next 6 to 12 to 24 months. But it's not really suitable for a client that's looking at a longer term investment, such as this one here. So for this client, we're going to look at a risk level 5 portfolio. So that's a portfolio where he's got 60% in equities, just under 40% in fixed income, with a little bit in alternatives and cash as well. And you can actually drill down into the underlying investments within each of these portfolios by just using the tools that you've been sent a link to a moment ago. But we're now going to create a projection based on the parameters that we've input here. So if we just remind ourselves, we're targeting £5,000 a month from these combined portfolios. We want it to start in 10 years' time when we're 65, and we want it to last until the age of 95. We're factoring in an inflation rate of 2.7% per annum, which means that actually the initial amount we're withdrawing in the first month is £6,526, and the final amount is actually over £14,500. So it just shows you it's really important to factor in the impact of inflation, because it makes a huge difference on what the sustainable level of income is that you can draw from your portfolios. So here we can see the potential range of performance outcomes. We can see the client accumulating wealth during the accumulation stage of their life. And then during the decumulation stage, we can see them drawing on their portfolios. And that's when it might be really important to speak to a financial advisor. Within our advice team here, we do a lot of work with clients about being efficient in drawing from their portfolios and using a blended approach to take advantage of their tax rates, their tax allowances, as well as their spouses. So perhaps drawing from a combination of you and your partner's portfolios to ensure you're utilizing your tax-free allowances and your personal allowances, as well as your basic rate band, to ensure you're minimizing the level of tax you're paying overall. So it can be quite an intricate and thoughtful process, and it's something that we're very happy to discuss with clients on a personal level. So you can always just speak with an advisor here by pressing this button and booking a call with one of us, and then we can discuss that with you. But what we can see here is that in strong and average market return scenario, the client is going to comfortably achieve this goal with actually quite a sizable amount remaining at the end of that investment period, which is obviously great to see. So maybe that he thinks, okay, well, I can afford to retire earlier, or perhaps I want to reduce the contributions I'm making while I'm still working because I'd like to have more disposable income during that time. So these are quite thoughtful things that you can have a look at the impact they'll have on the life expectancy of your assets. So I'd really recommend having a look at these tools and just having a play around with them. But one of the final things I just wanted to show you before I pass back to Fred is also our tax allowances and services dashboard that's available for clients. And this is really just to circle back to the importance of being efficient from a tax perspective whilst you're still working and whilst you're building up your wealth over time. And this is what our tax allowances and service dashboard is designed to do from clients. So here we encourage clients each year on an automated basis to move funds from their taxable portfolios into their ISAs, all their children's ISAs, all their spouses' ISAs at the beginning of each tax year, to ensure that they're moving funds from a taxable environment into a tax-free environment as soon as they're able to do so. So we're able to speak with clients about how they may want to do that, or they can just instruct us to do it here via the dashboard. Another service we have is a capital gains tax service, where clients can review their tax position at any point throughout the year and also instruct us to utilize their full capital gains tax allowance within our portfolio. So that's where we would crystallize gains within the portfolio up to their tax-free allowances. We would buy a subset asset class, which gave them a similar exposure to the original asset class. And then after a certain period of time, we would buy back the original asset class, which just has the effect of rebasing it at a slightly higher value, so that when you do ultimately come to withdraw from the portfolio, hopefully we're managing the amount that will be subject to capital gains tax. But again, if you would like to talk to any advisors about the features or how we can help you be more efficient from a tax perspective, please do contact us at advice@netwealth.com. But now, just to close off, I'm gonna pass back to Fred, who's hopefully going to look at some of the strategies for getting invested, and also provide a bit more information around the Netwealth services. So Fred, I'll pass over to you now.
Thank you, Louisa. So just a few more minutes to show you some of the strategies. So just to bring everything we've talked about together. And this is something I show my clients, and it's extremely powerful. thinking back to if we're holding cash and should we get back into the market, and no, it's hard to time the market, so the timing is very important. If we look at the S&P 500 since 1987, we can see significant volatility. So we see markets rising, we then see it falling, rising again, falling, the sharp rises, etc. A very long bull market here from 2009 to 2022. We see a fall and then we see it rising again. So it is always tempting to try and time it. So moving into cash, and we see cash rates and being attractive, and some people have asked some questions about different cash rates too, about ISA rates, why banks offer different ISA rates, and it's just about there being a market there. So it's about shopping around, trying to find the best you can get. But really, that long term markets do rise. So if you time it correctly, perhaps you can achieve a very strong return. But ultimately, it is difficult to do, and even the best wealth managers in the world do struggle for that as well. So if you missed the top 10 trading days in this period, so just 10 days out of about 30 years nearly, or just over 30 years, you would have only been up just under 2,000%. So still a really, really good return. Um, but if you just stayed in the market in 1987 and gone through that 30 plus years, you'd be up 4,284%. So it is a huge difference. Missing out on those best days, and it does have a big impact. And so we believe the best strategy, and this is true across the market, the best strategy is to stay invested for the course, and it's time in the market, which is really, really crucial. So timing can improve things, but it's just very, very difficult to do. Um, so waiting for a market pullback, and this just illustrates that point. Now, if you were to wait for the market pullback, um, if you stayed in the market too long, you would just miss out on those returns. So if you held cash a bit too long, you missed these large jumps, and that has a huge impact. And those jumps can happen quite quickly. They can happen quite suddenly. If we look at 2023, we do have people that held cash for, which is fine, and moved into risk level one, or maybe waiting to invest. They've got cash elsewhere. They're thinking about what to do with it. In 2023, even with interest rates at 5% and the cash returns being available at 5 to 6%, our balanced portfolio and upwards did outperform cash. So you were rewarded for taking risk, and now you would be in a strong position to benefit from the improving global economy, which we're seeing. There are still risks out there, so certainly don't put all your eggs in one basket, but that's why the asset allocation is so important. Hold enough cash to meet your short-term needs in your pot one as a strong cash reserve, at least 6 to 12 months, we would say, if you're working, longer if you're retired. But beyond that, have an appropriate asset allocation to benefit from the growth of markets. But the other strategies to help protect against falling markets. So if you are concerned about the markets, we've seen today, the UK entered a recession. We've seen some there's political risk in the economy at the moment. So if you tune into some of our other webinars by our economic strategist Jerry Lyons, he'll say that this year really is it's peak politics. So we've seen interest rates be a big factor in previous years. We've seen inflation be a huge factor in the recent year too. This year, we think politics is going to be a bigger factor than normal, as we're seeing increasing war, increasing volatility, increasing uncertainty from a number of different actors around the world, a number of different regions, and that can cause contagion. So if you are concerned about that and you don't want to jump into the market on day one, you can stagger. And staggering is a really important strategy, and it's going on for a very, very long time, and some of our clients do that, and we often do recommend it as well. We may not recommend it in all cases because statistically you are often better off if you put it all in on day one and for the course, but staggering can help protect you against falling markets. And it may be the case that for cautious people, and we see this in behavioral economics too, a loss tends to be felt much more significantly than a gain. So if you have £100 and it goes down to 80, you're going to be often feel that in a much more negative way, react more negatively to that loss than if it went up £20. So protecting against falling markets, being more cautious, trying to, I guess, reduce the downside, even if it means missing out on some upside, can psychologically make us feel better. So this is a perfectly fine strategy. If markets are falling, this can definitely work in your favor. So if you look at the grey line, if you'd invested on day one in a period of falling markets, you would be still have been positive territory. but you would have done better if you'd staggered it over 5 months and also 10 months, as you can see at the end of the chart here. So staggering can be a good strategy, particularly if you're cautious. Equally, though, it can go the other way. So if markets are rising while you're staggering, and this may have been the case in the last 12 months, um, you would have missed out on that return as markets are rising. So it can go either way. Generally, we advocate mostly investing on day one, but we do recognize that people can be cautious. We do fully appreciate behavioral economics, and so staggering can just be a bit more prudent for some people, and that's a strategy that we can help with too. And then just finally, just the net wealth approach. So we have a team of advisors on hand to complement the investment team. As you would have seen, we run 7 investment portfolios. We manage those internally by our investment team, who do all the research themselves. They manage the strategic asset allocation and select the instruments which they're going to implement the asset allocation with. As Louisa mentioned, that's mostly passive funds, but we do have the full investment universe available to us to select instruments from to build our portfolios. But really our focus, and this is a conclusion from our research, is that keeping costs low, using passive funds tends to lead to better outcomes. And we can really add value by this top strategic asset allocation and some tactical weightings throughout the year to lean more towards other asset classes or economies if we think there's surplus value to be had there. But generally, we're using passive funds to keep costs low. So our investment portfolios are managed by the team, and then we can complement that with advice on the financial planning. So whether that's retiring, getting invested, gifting, estate planning, how much risk you should be taking to meet various objectives, we can help you with that. As Louisa demonstrates, our technology that we built ourselves is available to all clients, and even people who aren't clients yet, no, that's free to use if you register. So you can use our modeling tools. You can look at our content hub. We write articles regularly by various members of the team, the advice or the investment team, to help people understand financial planning and markets and help navigate that. So give our insight around the global economy. Our senior management team, very experienced. The same senior management team that started the company is still in place. So we're led by a very strong team who are helping us implement our services in a robust way. And then lower fees. So as we've demonstrated, we believe fees are an important factor, and that's one of the reasons why Netwealth was started. We wanted to offer a really strong alternative to the current wealth management industry, provide an excellent service without any compromise, but also deliver that at a lower cost. So ultimately, you can keep more of your money. So if you do have any questions, do email us. We are available at advice@netwealth.com. Somebody will get back to you very quickly. Our email address here on the slide. So really just to summarize today, um, it is tempting, obviously, to look at the cash rates on offer and see markets and uncertainty and think I'll hold more cash than normal. But just do bear in mind that markets can move quickly, and ultimately that will probably be a drag on your long-term returns. So we advocate holding the correct amount of cash, benefit from those higher rates that are available now, but invest in a prudent and balanced way for the rest of your wealth that isn't needed for your short-term needs. And just to point out some of the other charts too about timing the market's difficult. So do speak with an advisor or a wealth manager. Do have a think. Send us an email, and we can help talk through those different principles and processes and understand your circumstances and help in any way we can. So just wanted to thank you all for joining, and hopefully speak to some of you soon. And do enjoy the rest of your afternoon.